Hi there, I'm Laura from Principal. Wherever you're joining me from, I'm glad you're here. Planning for healthcare costs in retirement is a lot like planning for retirement itself. You don't want to save for your post-work years until you're ready to make your first withdrawal, and you don't want to start thinking about rising healthcare costs after you leave the workforce. Why? Healthcare costs are one of the largest expenses in retirement. After decades of planning and saving for retirement, you wouldn't want unexpected medical costs to undo your hard work. There are steps you can take today to properly prepare for your future. And today we'll cover the important things to know when planning for healthcare expenses. Ways to save and pay for healthcare costs, whether long-term care may be right for you, and health insurance options if you plan to leave work early or retire before eligible for Medicare. First, we'll watch a short video. Then we'll get back together to answer some top questions around retirement healthcare, such as healthcare options if you retire early, Medicare enrollment and coverage, and long-term care insurance costs. If you have questions of your own, you can submit them anytime using the Q&A feature. We'll answer your questions as they come in. After today's event concludes, we'll send out an email with a link to watch the webinar replay in case you missed any information. So enjoy the video and let's get started.
There are a lot of things to think about when it comes to planning for your retirement, and it's easy to focus on the good stuff, like how your savings can allow you to travel, learn new hobbies, or spend more time with loved ones. However, with all that to consider, sometimes healthcare costs can be overlooked or be underestimated. So it may surprise you to learn that recent studies show that a typical couple will spend more than $660,000 on healthcare costs over the course of their retirement. The good news is, it's not too late to plan for managing your healthcare costs in retirement. Start by asking yourself these 3 questions. 1. How does Medicare factor into your plans? 2. How will you pay for healthcare when you're retired? And 3. Should you have long-term care insurance? Let's start with Medicare. When you turn 65, you can choose from several Medicare options. We'll briefly touch on each part, A through D. Medicare Part A includes hospital coverage, skilled nursing facility, home health, and hospice care. And you may not have to pay a premium for Part A if you or your spouse paid Medicare taxes for a certain amount of time while working. Part B includes such medical care as doctor visits, lab tests, x-rays, and other outpatient services. For Part B, premiums vary based on your income. Part A and Part B together are called Original Medicare. As a reminder, be sure to enroll as soon as you're eligible. Otherwise, you may be charged a late enrollment penalty where your premiums will increase 10% for every 12 months you didn't enroll. To make sure you have coverage when you're eligible, it may be a good idea to start the enrollment process about 3 months before you turn 65. Now, Part A and Part B are often combined with Part D, which covers prescription drugs. Private insurance companies also offer prescription plans, and costs will vary. You've probably heard the term donut hole in relation to Medicare, and Part D is where it comes into play. It refers to a coverage gap that begins when you've received $4,430 worth of prescription drugs and ends when you've hit $7,050. In between there, you'll pay 25% of the cost for both brand name and generic meds, but you'll also receive credit for what you've paid while you're in the donut hole. Medicare Part C is also known as the Medicare Advantage, and while it combines Parts A, B, and D, it's only available from private insurers. Premium costs will vary by insurer, and by law, Part C must be at least equivalent to regular Parts A and B. Some plans, of course, offer greater coverage. To compare all the different plans and costs, visit Medicare.gov. Then, once you've studied up on your options and learned all the details, you can start the enrollment process if you're eligible. You can enroll at age 65 even if you're not retired or collecting Social Security. There are 4 enrollment periods. First, the initial enrollment period, which runs from 3 months before your 65th birthday to 3 months after. Then there's the general enrollment period from January 1st through March 31st. Followed by the open enrollment period from October 15th through December 7th. There's also a special enrollment period, which lasts for 8 months after the end of any group coverage you might have through your employer. For any of these periods, you can enroll online at Medicare.gov or by calling the Social Security Administration. If you're still working when you enroll and you have health insurance through your employer, be sure to talk to your benefits administrator to see how this insurance works with Medicare. The answer is different for each provider. Occasionally, people need to change their Medicare coverage, but don't worry, it's not a complicated process. You can make changes during the open enrollment period between October 15th and December 7th, but also in several special circumstances. Examples include moving to a new residence, retiring after 65 and being taken off your employer-sponsored plan or your spouse's, qualifying for extra help with prescription drug costs, becoming eligible for Medicaid, and undergoing care in a skilled nursing facility or long-term care hospital. There are a lot of options surrounding Medicare alone, so if you need some help deciding on the right one, feel free to talk to a financial professional. The second question: when you retire, how are you going to pay for your Medicare premiums and other expenses not covered by Medicare? The answer depends on your work situation. If you're still working, for instance, a health savings account might be just the thing. You might already have an HSA through your employer's high-deductible health plan. If so, this money can be used for expenses both before and during retirement, including Medicare and other insurance premiums, doctor visits, eyeglasses and contact lenses, nursing home services, dental treatments, and more. You can open and contribute to an HSA at age 65 or later if you meet HSA eligibility requirements. You must be covered on an HSA-qualified medical plan. You're not someone's tax dependent, and you don't have any conflicting coverage, including enrollment in Medicare. You can also use these funds for medical expenses without paying taxes on them. Once you turn 65, there's no longer a penalty for using HSA funds for non-medical expenses, although in that case, those funds are still taxable. What if you're about to retire but you're not 65 yet? Some employers offer an early retiree insurance program, in which case you'd stay in the same group as your previous coworkers. These programs generally offer coverage for a fixed period or until the retiree becomes eligible for Medicare. You might also be able to stay on your spouse's employer-sponsored plan or find coverage through the Affordable Care Act or ACA. You can sign up for an ACA plan 60 days on either side of your retirement. Another option for retirees who aren't 65 yet is a COBRA plan, which will extend your employer coverage for 18 months after you leave your job. The premium can be rather costly, but COBRA is a legitimate option if you're, say, 63 and a half and just need a bridge to Medicare at age 65. If you're already retired, you have several healthcare payment options. Many veterans can qualify for benefits through the Veterans Benefits Administration. You can also purchase individual coverage at healthcare.gov, or if your spouse is still working, see if there's a way to join their employer's healthcare plan if HSA eligibility requirements are met in this scenario as well. In addition, funds you've saved in a retirement savings plan, like an IRA, might also help with healthcare expenses. In this case, of course, you'll want to check with your financial professional to make sure any distributions won't affect your Medicare premiums. Finally, let's consider the question, should you have long-term care insurance? This is the type of policy that covers nursing homes, assisted living, or at-home care costs, all of which tend to come with a hefty price tag. An assisted living facility might cost you $51,000 a year. A semi-private room in a nursing home is almost twice that. Long-term care insurance is generally not covered by Medicare, and like life insurance, it will get more expensive as you get older. Certain policies may be affected by your health history, how much care you'll need, and numerous other factors. Women generally live longer than men and are more likely to submit a long-term care claim, so their premiums tend to be higher. Married couples generally have lower premiums than single men and women. And keep in mind that different insurers might have different costs for the same coverage. It's a good idea to shop around and compare quotes to get the best deal. What sort of coverage will you need? The more detailed coverage can also be more expensive. Among the items you'll want to consider are restrictions on care coverage, the length of elimination periods, and limits to daily and lifetime benefits. Inflation can also be a factor as long-term care costs rise, but some insurers offer inflation protection options. Also, your premiums can be paid through any HSA funds. Long-term care insurance can get complicated, so it's a good idea to spend some time researching to learn about the different costs and benefits. Visit principal.com/milestones to learn more. You might also want to talk with a financial professional to get an even better idea of what long-term care entails for your specific situation. Don't have one? We can help. Visit Principal.com to search for a financial professional in your area. By learning about potential healthcare costs in retirement and planning now, you're setting yourself up for a more worry-free future. So, when retirement finally comes, you can focus on fully enjoying it.
Welcome back. I hope you enjoyed the video. Now let's dig into the questions. Our first question today is, if I retire early, what are my healthcare options and how do I pay for them? There could be a couple options available to you if you plan on retiring early. The first is to see if your employer offers an early retiree insurance policy. Talk with your HR professional to see if that's an option available to you. Another common option is through COBRA, where you could extend your employer's healthcare plan coverage. Just note, it may cost extra and there's usually a time limit on how long you can stay on COBRA. Generally, that's between 18 to 36 months, but dependent on your situation. Also, individual insurance through healthcare.gov is an option too. You can compare prices and plans on their website to see what can work best for your situation to help get health insurance coverage. If you're a veteran, you may also be able to qualify for coverage through Veterans Benefits Administration. Visit benefits.va.gov for more information. And lastly, if you have a spouse and they're still working with the option of healthcare coverage, you can enroll on their plan. Our next question is, if I work past age 65, do I still have to enroll in Medicare? Great question. And generally, if you have health insurance through your job or it's through a spouse's current job, you don't need to sign up for Medicare while you're still working. You can always wait to sign up until you stop working or lost your health insurance, whichever comes first. Be sure to know when you're planning on retiring and when health insurance or your job would stop. That way you don't get hit with late fees and you can reduce a gap in coverage. A financial professional can help you through this process. If you need help finding one, visit Principal.com. Next up we have, do any parts of Medicare have dependent coverage? Medicare is individual insurance, not family insurance, and coverage does not include spouses and children. Unlike other types of insurance, Medicare is not offered to your family or dependents once you enroll. To get Medicare, each person must qualify on their own. As a reminder, you qualify for Medicare if you're 65 or older, a U.S. citizen or permanent legal resident who's been in the U.S. for at least 5 years, have worked 10 years and paid Medicare taxes. You can also qualify if you're younger than 65, but are disabled and have certain medical conditions. If you enroll in Medicare, your spouse will need their own separate coverage, either through their employer or Medicare. If applicable, and if you're responsible for any dependent children, they would need coverage from either a spouse's employer or the open market. Visit healthcare.gov to research options for dependent coverage if you're in this situation. Our next question today is, if I miss the Medicare enrollment period, can I join anytime? If you miss your initial Medicare enrollment period, you do have some options available. You can enroll during the Medicare General Enrollment Period, which runs from January 1st through March 31st each year. There's also an open enrollment period at the end of each year that takes place from October 15th to December 7th. Typically, this is where most individuals change their existing Medicare coverage. Certain situations that allow you to qualify for a special enrollment period, such as if you retire anytime after age 65 and will no longer be covered by you or your working spouse's employer-sponsored plan. You move. You qualify for extra help with Medicare prescription drug costs. You're eligible for Medicaid. You're receiving care in an institution such as a skilled nursing facility or long-term care hospital. Depending on the reason you missed the enrollment period, you may need to pay late enrollment penalties. Our final question today is, how much does long-term care insurance cost, and when should I buy it? It might be hard to imagine now, but you may need some help taking care of yourself later in life. Nearly 70% of 65-year-old people will need long-term care services or support. The median monthly cost for in-home care is around $5,000. For community and assisted living, it's up to $4,500. And for nursing home, it's up to $9,000. That's why long-term care is an important consideration in a long-term financial plan, especially in your 50s and beyond. If you don't have insurance to cover long-term care, you'll have to pay for it yourself in most states. Waiting until you need to buy coverage may not be an option, as you may not qualify for long-term care insurance if you already have a debilitating condition. So most people purchase long-term care insurance in their mid-50s to mid-60s. The cost depends on the policy and type of benefit you choose, where care is covered, and when the benefits start. The average combined premiums for a 55-year-old couple is $3,050 a year. You can buy directly from an insurance company or through an agent. Talk with a financial professional to see what options are available and what would work best for you. That concludes the Q&A portion of today's events. We'll continue answering questions in the queue. Hang tight if you haven't received your response yet. We take time to answer each question we receive. What can you do next? A holistic plan to pay for healthcare may include several of the options mentioned today. A financial professional can help weigh your options and find a solution that fits together with your retirement and long-term financial goals. Visit Principal.com to search and find one near you. If you'd like to estimate your coverage needs and start visualizing retirement with your own information, see our planning resources and calculators available at Principal.com/calculators. Thanks for tuning in today. We'll send an email with a link to watch the replay if you missed any information. To replay or share this webinar and see a list of upcoming webinars, visit Principal.com/learnnow. You always have 24/7 access to replays. Take care, and we hope you'll join us again soon.